We had a new Fed chair announcement alongside a Federal Reserve meeting and some important appreciation data to cap off a volatile January and start to the 2026 year. Good afternoon and welcome to February. It's now official. We will be seeing a change at the top of the Federal Reserve, with Kevin Warsh set to replace Jerome Powell as Fed chair when Powell's term ends in May. Warsh is generally viewed as more of a quote-unquote dove, meaning he tends to favor lower rates to help keep the economy operating efficiently, which markets are taking as a positive shift. The announcement ended up being delayed from its originally expected Wednesday timing ahead of the Fed's January decision, so markets are still in the process of digesting the news. We did see some reaction late last week and over the weekend, particularly in precious metals, as investors adjusted to the potential policy implications going forward. Let's dive into what took place last week and how it affects you. Here are your headlines. As widely expected, the Federal Reserve held its benchmark Fed funds rate steady at a range of 3.5 to 3.75%, following three consecutive 25 basis point cuts to end last year. While the Fed funds rate doesn't directly determine mortgage rates, it plays a key role in shaping borrowing costs across the broader economy. So what is the bigger picture? The pause itself wasn't a surprise, but the decision wasn't unanimous. Governors Stephen Miran and Christopher Waller pushed for another quarter-point cut, highlighting the Fed's ongoing balancing act, sticky inflation that's still above target versus a labor market that's starting to cool. Inflation continues to limit how aggressively the Fed can ease, while softer employment data increases the pressure to act. The Fed also made a notable change to its statement, removing language from December that referenced rising downside risks to employment. That change drew strong pushback from Waller, who dissented and warned that, quote, substantial deterioration in the labor market is a significant risk, end quote. For now, markets are pricing in rates staying on hold over the next two meetings, but that outlook could change quickly as new economic data comes in. The Case-Shiller Home Price Index, one of the most closely watched measures of home values, recorded a 0.1% decline from October to November before seasonal adjustments. After accounting for normal seasonal patterns, prices rose 0.4%, and on an annual basis, national home prices remained 1.4% higher than a year ago, matching October's year-over-year gain. Now, the FHFA Home Price Index, which tracks homes financed with conventional mortgages and excludes cash and jumbo purchases, painted an even stronger picture. Prices rose 0.6% month over month on a seasonally adjusted basis and were up 1.9% compared to last year. So what does this mean for you? Buyer demand has picked up as mortgage rates have eased over the past few months, which has helped support home prices. At the same time, home builders have pulled back on activity and can't quickly add new supply, since new homes still have to move through the permitting, construction, and completion process. If mortgage rates continue to trend lower, renewed buyer demand could put additional upward pressure on home prices. Now, initial jobless claims fell by 1,000 to 209,000, while continuing claims declined by 38,000 to 1.827 million, though they have remained elevated for much of the past year. Some workers appear to be opting for gig or contract roles instead of filing for unemployment, while others are facing longer job searches. Now, December's Producer Price Index showed wholesale inflation rising 0.5% month over month and 3% year over year. Core producer prices, which exclude food and energy, increased 0.7% for the month and 3.3% from a year earlier. While the data came in hotter than expected, price pressures were relatively narrow, with much of the increase concentrated in machinery and equipment wholesaling margins. It's jobs week, and we've already hit a bit of a speed bump. A partial government shutdown over the weekend has created some uncertainty, with a potential resolution in the House expected on Tuesday. As of this morning, the shutdown means the BLS Jobs Report will not be released this Friday. That said, we're still getting important labor data, including JOLTS report this morning, private payroll numbers from ADP tomorrow. With the 10-year Treasury inching back toward the 4.3%, we will need these reports to come in on the softer side if we want mortgage rates to move back onto a downward path. I'll be in touch on Tuesday with an update, but for now, have a great rest of your day.